So I actually think, weakness here should be bought, and I'd still be buying dips because I think the scope of what can be accomplished with tariffs has actually shrunk. It means when we think outside the next couple of months, I think that ultimately it's pushing us closer to a resolution. When markets really believe the tariff sort of story and saga is behind us, I think it's going to be a very big cyclical rally. So, over the last couple of weeks, as markets rallied, our macro clients have actually been really fighting this tape. They've been very skeptical of stocks rising, and we can see it in the prime brokerage data where gross is actually high, but net is low, meaning hedge funds are shorting this rally.
A lot to get in there by Tom Lee, and a lot has happened since the last time I've seen you guys. So on Sunday night, the markets rallied because the Court of International Trade, who knows what the hell that is, I never heard of them until now, blocked Trump's tariffs. Now, Trump immediately put in an appeals, and the appeals court then paused the ruling that blocked the tariffs. Now, we lost all of those gains, and as a matter of fact, the market did turn red. All we did was sweep the liquidity above these equal highs here, as you could see, and my thesis still stands that we have more downside left to fill this gap and give us a nice little pullback. And I actually agree with Tom Lee there. As I've told you, I do not think we are going to revisit those lows unless we start seeing material effects from the tariffs on the ground. But one of the things he said was that he thinks what can be accomplished by tariffs is actually narrowing, and he's right on that. So not only doesn't the world believe anymore, aside from China, we'll leave China aside, but not only doesn't the world believe anymore that he's going to impose 100% tariff on EU or 50% tariff on EU, right? He's given the EU and all other countries not named China a massive reprieve. Like, it's obvious that we are not going to get those massive tariffs with our trading partners. But the other thing he said was to buy the dips. And this is something that I keep getting a few comments about. Why do I think the market is going higher? And we'll get into that in this video. So let's jump into the analysis. Can the S&P 500 hit 6,600 by the end of the year? What stocks should you be buying the dips on? And if you took that sneaky little Nvidia Iron Condor that I gave you in the last video, make sure to leave it in the comment section below. That is up 90% as Nvidia did not make the expected move. And towards the end of the video, I will post my short that I took in real time in front of 600 people. Even though the market was up today, why did I think we would lose those gains? I will post the trade as well as the explanation, which was taken live, and you will see that. Let's get right into it. So the appeals court paused the ruling that blocked the Trump tariffs. At this point, it's just becoming even more ridiculous, this on again, off again thing. But more importantly, what happened from a technical level? Let's dive into it. So if we look at the March high, you can see here on the left, I have the NASDAQ. It made a higher high. On the right, we have the S&P 500. It made a lower high. This right here is called bearish divergence, and it still stands. Secondly, I want you to note where the S&P futures got rejected from. This is not a miracle. If we take a look at it, you could see that it got rejected from the 2025 opening price. This is the exact price right here, 2025 opening price, that the S&P 500 opened the year from. These levels matter, folks. So we have the bearish divergence, the rejection off the 2025 opening price. We have the liquidity sweep above all of these equal highs on the NASDAQ and on the S&P. Now, I believe that the market is pulling back from this level because of this on again, off again game. But I don't think that the market is terrified anymore of what tariffs might do. I think there is a little bit of an uncertainty there, and that's what we're seeing. And I think that the market technically and fundamentally is due for a little pullback, especially after the credit downgrade that we discussed, 2 weeks ago now? So if you want to confirm whether we get more downside or not, we have to close below this fair value gap on both the S&P 500 and the NASDAQ. This gap right here between the dates of May 23rd and May 28th. Pull up a chart on your own and you can see this is the daily chart. If we close below this, then we are for sure, in my opinion, going towards that May 9th to May 12th gap that both the S&P 500 and the NASDAQ have. Now, I want to get into Nvidia earnings a bit and tell you why I shorted Nvidia, but let's take a look at some stocks here that would coincide with that pullback. So if you look at Meta, I told you guys that this gap here would be my dollar cost average level for Meta. as well as potential plays such as options, which I will send out in the Discord. This also coincides with a potential play on Amazon. Can fill this gap here in the golden pocket. Tesla is staying strong here. Green today, barely moved, even though the market had lost most of its gains. And I still think that Tesla is due for even more of a breakout. Now, I'm not going to brag, but it did get to that level. What did I tell you guys a few videos ago? This was my target here, my first target for the Robotaxi event. I think it eventually gets to 400 and above. There is a gap here that we are looking to fill. I don't hate Tesla calls depending on what happens the next couple of days. But that right there, that 400 level is the next target on Tesla. These are just some of the examples that I'm looking at that would coincide with that drop in the NASDAQ. But remember, the NASDAQ and the S&P 500 have to close below this gap here. We can, I'm not trying to be a perfect predictor. I'm just staying ready based on the probabilities. And I personally think that we could drop a little bit more. I'm not saying we're going to tank. I think we could drop a little bit more to these sensical support levels here, but we do need to close below this. We could easily bounce from this and go higher. I'm not under any illusion. My objective is not to predict every move. My objective is to be ready for when the opportunistic move happens. So let's talk about Tom Lee's path to 6,600. And why I think that this is a buy the dip scenario. By the way, I've told you guys time and time again, if you guys don't like the volatility, if you are uncomfortable with the on again, off again tariff game, if you bought stocks on the dip and you've been following these videos and you bought Meta, SPY, QQQ, Google, Tesla, all the levels that I gave you in the videos for the last 3 months, and you are sitting pretty right now and you say, you know what, I'm out. I'm just going to put my money in treasuries and earn 5% and wait this thing out. Trust me, I do not blame you. But at the moment, we have so much data that supports a higher stock market 12 months after the data was published. You can see here when we have a near bear market of 19%, which we've actually had quite a few of, just like the S&P 500 did this year. The returns are double digit always 12 months later. I've shared with you data of what happens when the S&P 500 drops 10% in 2 days. 12 months later, we are always up double digit percentages. New data from IsabelNet. This is one of my favorite research companies, but when May, which is typically a shit month, when May is up over 5%, 100% of the time, stocks are higher a year later, with the average return being 20%. So where does that take us on the S&P 500? If we take a look at the S&P 500 and we look at the open right there, and we just measure a double-digit percentage gain, a modest double-digit percentage gain, from the year, you could see that 10% up from the 2025 open is 6,500. So Tom Lee's call for 6,600 is actually not out of line based on data. Now, one more interesting thing that Tom Lee said is that the prime brokerage data indicates that hedge funds are a net short. So I looked this up in Grok, and yes, what he's saying is true. Recent prime brokerage data indicates hedge funds are net short. Now, I told you guys about hedge funds being net short in April, which is part of the reason we got such a squeeze. But there's been a $25 billion surge in hedge fund short positions in May of 2025. This is the highest in a decade, with shorts comprising 41% of total open interest, the most since February 2021. Do you guys remember February 2021 or 2021 at all? This was February 2021 right here. And we went on a massive bull rally before suffering a bear market in 2022. Now, aside from prime brokerage data, we know that institutions, less risky institutions, not hedge funds, but institutions such as mutual funds, pension funds, endowments, etc., we know that they have been chasing this rally. As a matter of fact, here's Morgan Stanley's Mike Wilson talking about this very thing.
Our work suggests that right now, retail is buying $5 billion a day, steady state, okay? Systematic strategies, CTAs, are buying about $5 to $6 billion a day for the next 30 days, because unless the market really falls out of bed, they're trend following. And corporates are buying about $5 billion a day. So you have $15 billion a day of demand in like S&P type products, NASDAQ 100, whatever, the big stuff.
And lastly, in terms of bullish catalysts, we have the big, beautiful bill. Now, this is something I personally don't agree with. I was on board with cutting bloat from the government, cutting spending, finding excesses in government spending, not greenlighting any programs for new government spending. I was on board with all that stuff. I was even on board with tariffs, depending on how they were rolled out, as long as they brought in some money for the government, and that would allow us to cut taxes for our citizens. I was on board with that in theory. But, greenlighting $4 trillion in spending, that's inflationary to me. It's the same thing as money printing. And I do think that the stock market loves money printing. This was the last time that we passed a tax bill. We went straight up for an entire month, and then we had the correction of 2018. So I'm under no illusion that there is likely a reckoning coming at some point in the future. Like I said, I think when you print money, you basically kick the can down the road, the recession can down the road, because the immediate liquidity causes enthusiasm. That money finds its way into the markets, but then eventually you get stuff like inflation, bond yields go crazy. If we're going to add $4 trillion to the debt, that means that bond yields, which are still crazy, are going to rally. There has to be a reckoning somewhere. Now, Trump did meet with Jerome Powell today. Nobody knows what they really talked about. But unless the Fed starts purchasing treasuries again, which would once again be inflationary and money printing, I don't see those bond yields coming down unless a recession happens. So I'm under no illusion that later down the road, we will get some sort of event that will not be pretty. But in the meantime, in the short to medium term, I do think that there's more upside for the markets. And I think that a lot of stocks that have been beaten up so much due to the tariff fears will likely find their way back to all-time highs. And I'm talking about very quality stocks. Anyway, if you got something out of this video, leave it a big fat thumbs up. Shout out to those of you that shorted the market with me today. Great success. If you want to trade live with me every morning, link is in the description below. Would love to have you. Let me know how you're positioned. What stocks are you buying? What stocks are you looking to buy? If we dip, are you completely out of the market? Are you still all in cash? Would love to hear from you. Watch out for a top stocks video. You guys asked me to do more of these top stocks to watch videos in the beginning of the month, so I might do one this weekend. I'm also going to be doing a futures course for the Discord members, the new ones that have joined, that are still getting their feet wet with regards to futures day trading. Subscribe to the channel, hit that notification bell, stay safe out there, traders. Oh, watch this short here on Nvidia. Peace.
The indices take out yesterday's low. That's the draw on liquidity. At least one of the indices, which ES is weaker than NQ. I don't know if we get a divergence there, but if we can retest this opening print on Nvidia, because puts are cheap since the IV crush, we need to get rejected here on the indices and head for that low. Taking the 143 puts on Nvidia expiring tomorrow. Oh, holy moly. Up 15% on these guys. Beautiful flush here, guys. Up 2,500 on this. 25%, guys. 25%, 40%, guys. Me. I day trade futures most of the time, but sometimes there is an options play, which is so obvious. Up 60%, we hit 70% on these puts. For me, I have runners because I still think the draw on liquidity is that. It was a pretty textbook play. So a lot of new people that joined have messaged me saying, oh, I thought you day trade options. I day trade futures mostly, and I will day trade options if an opportunity presents itself. Baffling to me when people think futures are more complicated and so they avoid it. You don't have to think about anything with futures except for, do I go long or short? That's it. With options, you got to think about expiration, strike price, call or put, spread, etc. Am I going to be subject to IV crush and theta decay and all that stuff? So here's the trade. Obviously, it all starts with the indices. I targeted that as the draw on liquidity. How did I know that? Well, based on how the chart looks, based on intuition, and the fact that by the time the market opened, we had already lost half of the overnight gains. Second to that, we took major liquidity. So we took these highs on ES and NQ, and you could see that wick there. So it seemed to me that yesterday's move, the overnight move, was just a liquidity sweep. So my bias was bearish on the day. Nvidia also gapped up because of earnings, but then something happened here. It also had its own little manipulation. But what happened with the indices to what happened with Nvidia, that right there is Nvidia's little manipulation over the pre-market highs, not the pre-market high. If you go to the 15-minute time frame, the first 15-minute candle that opens at 9:30 just mark out the high and the low. Before I took the trade, we crossed below it. Now you have to have a bearish bias for this to work. And I bought the at the money puts because it expires tomorrow. And so I don't want to go out of the money, because if I'm wrong, those out of the money puts that expire 1 DTE are going to tank. If I'm in the money or at the money, they're going to tank less if I'm wrong. And my stop was very close here. So a lot of people on the surface will be like, why would you short something that's up 5%? And that's not really the way to look at it. It's based on my overall market bias.